Okay. Is the audio level okay this time? That's the question. It's been a problem like in every stream. So I've spent some time playing around and I've tried to fix it, but who knows? It's usually really quiet on the video afterwards as well on YouTube. So yeah, I wanted to try and basically just max out everything. The bar that I'm looking at that shows the volume levels on the streaming software I'm using is just like completely maxed out. It looks like it's terrible, but hopefully at least it works. So yeah, if you're all happy, then a bit distorted but better. Okay. Yeah, I can probably lower it slightly, and then it will help remove a little bit of the distortion. We'll try that. See how that goes. Yeah, I really don't understand what it is that's that's causing it, to be honest. Very strange. But regardless, we'll move on anyway and try our best. I reduced it slightly from where it was, so I got rid of some of the distortion because it's like topping out on the microphone, but no promises. So, okay, as usual, I'm very late. Sorry. You know how it is with me. Obviously, before we get started, I'll go through the usual disclaimers. Let me bring up the screen so everyone can see the presentation. So my name is Jay, and most of you probably know me from eToro. If you're here for some other reason and you have no idea who I am, then I'm a popular investor on eToro. And this is our Q3 2022 performance update. So I'll mainly be talking about what happened in Q3, where we were positioned going into Q3, and what the results are compared with the benchmarks, and then also looking at Q4 as well. So as you can see here, start with an introduction, a bit about my strategy, but not too much because I think most copiers are aware of it, but obviously I was unblocked not too long ago, so that may well have brought in quite a few new people. It says Q2. Why does it say Q2? Does it actually say Q2? Is that the title of the stream? Did it change it again? I'm sure I changed it. Let me see. He says, hunting for a browser. Am I being trolled? So for the presentation? Oh yeah, it does. You're right. It says it right there. Oh my days. I knew I missed it somewhere. That's my fault. Sorry. But I promise you it's the right one. Look, the next slide's fine. Somewhere. Yeah, so Q3. Okay, we're going back. Let's start again because this has got off to a very poor start. Okay, right. So yeah, my name's Jay. We'll start with an introduction to myself for anyone who's not familiar with me, because obviously I was unblocked quite recently, so there's a lot of new copiers potentially who aren't familiar with my strategy and the way that I invest, the way I look at things. So we'll go over an introduction of me, my strategy, my background. After that, we'll look at performance for the quarter, comparing myself with some of the benchmarks. The primary benchmark I use is the NASDAQ 100, but I also list some other indices, so you can take a look at that as well. We'll look at how the market stood overall and how we were positioned going into the quarter. And then we'll go through the market and trading highlights for the quarter as well. So we'll see what kind of events were taking place during the quarter, what moved the markets, what were some of the key trades that I did, or repositioning of the portfolio, etc., etc. After that, I'll briefly talk about what I'm kind of looking at going forward into Q4 and into 2023 as we approach the end of the year. And then at the end, we'll have a short Q&A, hopefully with questions predominantly related to this. I know that there's been a lot going on in crypto, so I'm fully expecting there'll be some crypto questions as well, and that's fine as long as we, don't go too crazy with it, because I do have a second stream set up in a few days, which will be a more broad kind of Q&A for all of those kind of questions. So I can talk much more freely about everything else in that stream. But for this one, I want to try and keep it somewhat focused on the presentation on Q3 performance, current state of the portfolio, and on my eToro stuff. So try and keep your questions focused on that stuff for this stream if you can, and hold the rest off until the Q&A live stream. Okay. Oh, I forgot the very important disclaimers. So obviously, none of this, before I go any further, none of this constitutes financial advice. I don't understand your personal circumstances and your individual situation. So obviously, the commentary that I'm giving here is on my portfolio, and if you're copying me, then your portfolio should reflect mine. So that's really what I'm trying to talk about here. So I'm not trying to give any sort of legal or financial advice to anyone who's watching this. Okay, so this is me. I did update my picture from the one that was on there for a very long time of me in an orange hoodie in the woods somewhere. So this was a picture that was taken at the Popular Investor event that eToro hosted back in summer. That's me and Yoni. I still haven't taken a picture of my new desk setup. I keep saying that I will, but to be honest, it's pretty ugly at the moment since I moved into this place. I was planning on building an office, but all sorts of things have gotten in the way of that. So that's taking a bit longer than I would have hoped. But eventually, one day, I will update the photo of my my setup as well, just because I feel like I should. I have over 11 years of experience now investing, approaching 12, I guess. Not that I really kind of keep count, but I feel like I should update it at least once a year. I started out self-taught, but again, I should probably kind of add a caveat, an asterisk to this or something, because I also have a CISR qualification now in wealth management, essentially. So I learned everything that I was doing from my own experiences. I was always incredibly interested in economics, in business, in finance, in any sort of a system. I go diving down rabbit holes of things that I'm interested in. Sometimes that can be, railway systems. Sometimes it can be, a new kind of cryptocurrency project or something. But yeah, I just get fascinated with stuff and I love learning. And that's really, I think, what kind of led me towards investing, is that every day is different. You're always learning new things and looking at new things, and trying to, think of the future. My CAGR since joining eToro is over 30%. It was up to 40% at one point, but obviously with the way that this year has gone, that's dragged our number quite a bit lower, and you'll see that when we look at the year-to-date stats later on. Ideally, I would like to keep it above 30% for my entire career, to be honest. I realize that's a pretty big ask. There's very few people that have really managed to do anything close to that. But I would, I still kind of want to at least aim for it. I do think it is possible, but obviously very difficult, and increasingly difficult as your AUM grows over time as well, because it's hard to find investments that are going to grow by a massive amount if you're investing a massive amount, because companies are too small for you to put all that money into. So maybe that's part of the reason that it's declined a little bit as well, but still pretty happy with that statistic, to be honest, over my track record on eToro. I'm also someone that is quite outspoken on ethics, on the future, on most things, to be honest, on politics, and I pride myself on those views, to be honest. I run the portfolio in as ethical of a manner as I can, really. I don't really think it's possible to be 100% ethical. There's always going to be things that you miss, or things that you can't really account for. Just as there is with financial investing, there's a lot of things that are very difficult to measure, and ultimately comes down to kind of your opinion and speculation to some extent. But those are things that I pride myself on, and are a big part of who I am and what I believe. So pretty green person, environmentalist, and just generally think that what I'm doing on eToro is hopefully helping as many normal people as possible get good exposure to growth markets and grow their own personal finances. My background prior to becoming a popular investor is in gaming and events. So when I say gaming, I don't mean gambling. I mean PC gaming predominantly and esports. So I was a professional gamer for a while. I also worked for an events company in the gaming space. So I hosted events around Europe, and I've been to a lot of big venues. Worked with lots of major publishers and game companies and things as well. I also spent quite a lot of time in my career working in logistics, so I've got a pretty good understanding of those sorts of businesses as well. But generally, I guess my kind of focus has always really generally been on technology and kind of entertainment and those sorts of things. And that's the way that my investing tends to lean. I've been a full-time popular investor since 2017 as well. So yeah, pretty cool job, I guess. Strange job, but a cool job. Some track records, big numbers for you to fill the screen, because that's the thing people do with slideshows. They put big things on screens, and so here you go. There's the CAGR number. More specifically, that's as of the end of last month, according to eToro's stats that they put up on the fact sheet that they have for me. My assets under copy is over 70 million, or it was at the time that I produced this. It's actually over 75 now. I think it might even be closer to 80 now. I have over 20,000 copiers. I'm not sure why there's a comma after it, but I have over 20,000 copiers. And my lifetime return on eToro is still at over 1,100%. So if you copied me from the day I joined, which nobody did, by the way, and I wouldn't have asked them to either, you would have made that much money if you had copied me all that time. So it just kind of demonstrates how quickly things can compound, pretty crazy growth over that time period. So touching on my strategy, I always kind of like to caveat this slide when it comes up and point out that this isn't really in that much of an order, nor are these symbols weighted to how much time I spend on each one. But I'll go through it anyway. So generally, I do tend to start with trying to identify a future trend, something that's happening. For example, even today, obviously everyone's talking about the global population hitting 8 billion. A lot of people think that the population of the world is, increasing massively and is going to be a big problem of overpopulation, but actually the reverse is true. And that is a trend that I've been looking at for some time as well, in terms of how that will affect economies and different countries and different types of businesses. So generally that's the first thing I look for is a trend. It could be, something that's going on in how construction industry is working, or innovation in transport or logistics. But that's where I start. After that, I like to delve into the product specifically. This can involve reading manuals for solar products, which I have read far too many of. It's really quite sad how many I've read. But I feel that the amount of time that I spend looking into the products and actually going out and visiting them and seeing them in the flesh really does give me an advantage in investing, because I don't think most investors do that, and I don't think they really understand the pros and cons of the products and how those products really appeal to consumers as a result. And also you get to meet the sales staff and things like that if you do those sorts of things. Not really after that so much. This is the part where it kind of gets a bit blurry, but they all kind of help me form the decision. Sometimes they occur in different orders. But generally, I spend quite a lot of time looking through the fundamentals of a company. So looking through their balance sheet, their assets, liabilities, their income, where they're putting their costs as well sometimes can be quite interesting. Those are things that I look at for most companies that I invest in as well. Probably actually that's the area that I spend most time. Between product fundamentals and ESG is generally the area that I spend most of my time once I've kind of identified a trend. ESG is next, and it says ESG, but really I think it's a bit more than ESG, because ESG is essentially a set of criteria to actually measure risk more than anything else. But there isn't really, I think the terminology probably needs working on within the industry, to be honest. But I run more than ethical approach in terms of my investing. So I like to make sure that the companies I'm investing in are generally good for society. That's my kind of like tagline thing that I'm thinking of when I'm looking at them. Sometimes it may be that they don't have a perfect record on one thing, like how they treat their staff or their customers, or their supply chain or something, but they are building a product that is ultimately a massive benefit to society. So there are often trade-offs, sadly, but I try to make sure that overall these things are a net positive for the world, and that can be everything from looking after the local environment to how the governance structure is set up within the company, and how accountable the management team are, and things like that. Next up is portfolio fit, making sure that the company or asset that I have chosen to add to the portfolio is going to fit with that portfolio and complement it. It's often the case that you'll find 5 or 6 great investments, but if they're all in the same industry, then it obviously leaves your portfolio exposed to a lot of risk. Although I do still often have numerous companies within the same industry, and certainly an overlapping sectors, I often try to look at the beta between different assets and some of the things in the portfolio that are weighing differently on it, to make sure that overall I'm not taking on too much risk, which is obviously beneficial during markets like this. Sentiment is next. This can be as simple as looking through the social media feeds of different companies and seeing what people are talking about, if their customers are angry at them, if their staff are angry at them, looking at things like Glassdoor and websites like that to see what the sentiment of staff is and staff morale. These things are really important, I think, actually, in a company. Especially on the staff side of things, making sure that they're well motivated. I think Twitter is probably a pretty good example of that under Elon Musk at the moment. But generally, this is a pretty small part of my research process. And then lastly, we have technical analysis. So essentially, technicals, if you're not aware, is basically just looking at charts and trying to decide, if the market is kind of ready to bounce, or it really kind of actually ties in with sentiment in many ways. But it's something that I don't really spend too much time on, and probably has the lowest weighting of everything in this list, I would say. So that's enough about my strategy. Let's talk about how we were positioned going into Q3. So I still had a lot of exposure to technology. Obviously, tech is an incredibly broad description, but it's always difficult trying to break down your portfolio into a few chunks to kind of show where our exposure is. But this is the way that I decided to do it. I did reduce exposure to a lot of my tech stocks early in the year. I reduced it further after, for example, AMD gave their warning ahead of their earnings. I reduced exposure to them. I reduced exposure to Nvidia at the start of the year. There's lots of companies that I decreased exposure to throughout the year generally. But technology is still a large part of the portfolio. The largest, or one of the largest positions that I have in tech is Ubiquiti, which is what that screenshot is from. So Ubiquiti make marketing networking equipment predominantly, and is a company that I'm extremely bullish on. Technology is a major part of the portfolio, and to be honest, I think it always will be. But a bit less heavily weighted than normal, considering the market conditions we're in. The next big trend is electrification. I have exposure to this through a lot of different companies, and really, again, this can be considered a very broad thing. There are energy providers and suppliers. There are people who own renewable facilities. There are EV charging companies, there's EV companies generally. There's a lot of things that could fit into the electrification category. But I would say that companies like ABB, Siemens, ChargePoint, all of these kind of companies fit into this category reasonably well. Transport and logistics, another area that I've had quite a lot of exposure to over the years. And since I think 2 years ago, rail has been the largest chunk of that, actually. I have reduced exposure to that a bit, actually, through Q3. But going into Q3, we still had a lot of exposure to it. And I still think it's quite an important segment to hold exposure to, although generally it does fare a bit worse during bear markets. It's still a very stable kind of income stream, has good dividends and such. So the likes of CSX, Canadian Pacific, would fit in here. And also, again, I also kind of lumped in the automakers into this category as well somewhat. And again, even ABB would also fit into this category because they're involved in railways and ships, actually, massively. Hedging and dividends. So again, it's kind of a weird category to put in as hedging and dividends. Some of those are literally positions in ETFs that are following indices. Some of those are in leveraged ETFs that are kind of counter trading those indices, so that we're essentially shorting. Some of the things that I would include in this category would be companies like Unilever, for example, who provide a very stable dividend and are somewhat kind of inflation-proof, you could say, in terms of the kind of products and services that they offer. And of course, Lowe's, who I've got pictured as well. Again, another kind of big stable company with large dividends to pay out. So these were positions that I mainly picked up towards the start of the year, with the hope of just holding on to them, hopefully getting a small profit through the year and then cashing out with our dividends when the market is much lower, and rotating into some more growth positions when things are looking a bit more bullish. Industrial and commodity, again, ABB seems to fit into most of these categories now that I think about it. But, again, they're a good example here. Nucor is another position that I would put in here, obviously. Wire, which is a company in the US that produces copper cables. They fit in here. Commodities generally have been a really kind of interesting place to have exposure to, but for me, I'm much more experienced in investing in equities rather than directly into commodities. So that's the way that I like to try and get exposure to those industries. They are very cyclical, and obviously with the conflict in Ukraine, there was a lot going on early in the year that was kind of driving up prices in all sorts of different commodity areas. But even before that, there were some commodities that I was very bullish on and felt was very undervalued. So we still have quite a lot of exposure to things like steel and copper, and of course to much more kind of broad industrial products and things. And lastly, the thing that I guess I'm probably becoming more well known for on eToro now is renewables. So solar, wind, hydrogen, nuclear. We have a bit of nuclear exposure now. These are all industries that are growing massively. I think it's pretty undeniable that they are the future, but they also have pretty hefty price tags associated with them for that reason, and especially since the conflict in Ukraine started. But again, I still maintain very, very high exposure, especially to the solar industry going into Q3. Taking a look through our performance, or my performance, really, I suppose. You guys weren't really helping or hindering me in any way, I suppose. But I guess in many ways it's all of our performance together, if you are copying me. As you can see, I was basically flat for the quarter, really, minus 0.45%, so pretty negligibly down. But if you compare me with the benchmarks, I'm actually really quite happy with how Q3 went for our portfolio. So you can see the S&P was down by almost 5%. The Nasdaq wasn't too far behind it. Interesting that the S&P was slightly worse, so a slight rotation towards tech as people felt the market was bottoming out. And the Russell did even better than both of them. Russell 2000, which is obviously much more speculative small cap stocks. So again, indicating that some people were actually looking to take on board a bit more risk during the quarter. Over in Europe, the numbers in brackets at the bottom show the exchange rate against the US dollar for those indices because they're priced in their local currencies. So the FTSE was down 5% against the pound, but the pound was down against the dollar significantly through the quarter. So actually, it's doing a lot worse, and the same is true across Europe. Really, Germany in particular had a pretty nasty time, but the pound performed much worse than the euro. So you can also see that that was impactful as well. We do have a lot of exposure to Europe. Some German stocks, quite a few French positions, a few in the UK, quite a lot on the Copenhagen market, Stockholm, Zurich. The more I think about it, the more we seem to have, just off of the top of my head. So, we're quite diversified geographically. And that's something that's quite important to consider, I think, when you're looking at my relative performance against just the NASDAQ 100, which is what I use as my core benchmark. That's the thing I'm really trying to beat. But it's important to remember that I'm not just invested in US tech companies, especially at the moment. I'm actually invested in quite a lot safer positions than that. And again, a lot of those positions are in other countries. A lot of the revenue is coming from other countries where the currency is fluctuating quite a bit as well. So considering that all of those things were really going against me this quarter, that's actually a really pretty big outperformance. So really, really happy with how Q3 went overall. Looking at the year to date, slightly different story, as you can see. We are ahead of the NASDAQ by a couple of percentage points, but still down on the S&P 500, very far down on the FTSE 100, as you can see. But again, if you look at the numbers below that show the pound against the dollar, when you actually kind of add that on, you'll find that in most cases, these markets were behind the US markets. And the FTSE 100 is potentially somewhat of a bad benchmark in many ways because it's so heavily weighted towards financials, mining companies, oil and gas companies, and things like that, which are generally areas that I don't invest in very much. But it's still useful to have there rather than just having lots of European stuff. So yeah, for 2022, I think considering that we were kind of caught slightly off guard by the move in Q1 originally, and then Q2 was okay, but not great. I think we're moving in the right direction. I'm feeling pretty confident now. Obviously, we have hindsight now. All of these numbers are from the end of last month, and things have moved on quite a bit since then. So, we're actually looking even healthier now. But at the time, we were down for 30% for the year, which sounds like an awful lot of money, and it is an awful lot of money. But I think when you look at that in context with how much I gained in the years, even just the 2 years prior, in 2021 and 2020, it's really not that bad. Some of the tech stocks that I was investing in through 2020 and 2021 are down by 80% plus. Some companies are going bankrupt at the moment. So overall, I'm actually pretty happy, even at minus 30%. It's not something that is something that fills me with joy to be looking at. But when you kind of look at it in context of what's going on in the broader markets and what the options really are for where to place your money, and kind of hedge your bets, I think it's actually pretty okay overall. Lastly, we have the trailing 12 months number, and the end of last year was particularly rough for me. Q4, Q3 of 2021, I underperformed the markets, and you can somewhat see that in the stats, but in the fact that I'm behind the NASDAQ now instead of ahead of it for the last 12 months. But obviously, as time goes on, that number's changing, and things are looking a bit better for us again. So yeah, some level of kind of cyclical nature to things and to the markets. But as I said before, I'm pretty happy with how things are going. I mainly just added this slide because back when I was in Q1, it felt, or Q2, it felt really weird to have a year to date, and that was it really, and the recent quarter. So. Yeah, just a bit more kind of color for you, but I don't really have too much to add beyond what I've already said, really. Yeah. Okay, so in terms of what happened during Q3, well, a lot of things, to say the least. In the UK specifically, and it may feel like maybe I focus on the UK too much just because I'm from the UK, but I think it pretty much made international headlines in how disastrous Liz Truss's stewardship of the UK was for the few weeks that she was in charge. After Boris departed. So Liz and Kwasi Kwarteng, who's sat next to her in that photo, came out with a mini budget in the UK, which isn't a full budget. So legally, they don't have to get it vetted in the same ways and release it all to the opposition party and to the press and things early. And it's probably a good job they didn't, because it was really, really poor policy, and it really tanked the pound. The pound slid very, very hard against the dollar and against the euro, against everything pretty much, even the yen. It didn't do too well against. So, yeah, pretty disastrous situation in the UK. That had knock-on effects. There were pension funds and some of the banks and lending facilities in the UK that were struggling somewhat, and the Bank of England had to step in and essentially bail out the UK economy slightly to make up for the budget. Obviously, we know what happened to Liz Truss following that. She was out-survived by a lettuce, quite famously, and now we have someone else in charge in the UK, and who knows how much stability that may or may not bring. But I don't think it could be much worse than what we had. Maybe famous last words. We'll see. But obviously, this was a really major event in markets. Really, it kind of shook faith in the entire UK economy for a lot of countries. And, the UK was, until I think yesterday, actually, the largest stock exchange in Europe in terms of volume and value. And it no longer is. And I think that in itself is in many ways a sign of what really happened as a result of this, which is that a lot of people started to move their money out of the UK. And, again, the currency fluctuations that it caused also had massive impacts on a lot of companies. I don't have very many UK companies in my portfolio at the moment, specifically for this reason. I am bearish on the UK economy, very much so, and I'm bearish on the pound as well. So that means that having exposure to companies that are running money in the UK is going to be additional risk for the portfolio. So generally, I'm avoiding it. There are a few names in there, but even some of the assets that are listed on the London Stock Exchange aren't really generating most of their income in the UK in many cases. So take those with a pinch of salt if you're looking at them. The dollar strengthened. So again, this ties into the currency theme, but the strength of the US dollar has been phenomenal this year. Really, every other country around the world has kind of fallen behind it. A lot of that obviously is to do with the yields and the hiking of interest rates in the US. They've definitely been one of the most aggressive countries, far ahead of the Bank of England, for example, and certainly light years ahead of where the ECB is currently at. In terms of lifting rates. And that means that holding your money in dollars and kind of sitting in treasuries is going to be earning you good money. And so as a result, the US dollar is performing well. On top of that, I think that going hard and fast is generally a lesson that was learned from the global financial crisis in terms of how to manage an economy in these sorts of situations, and it's usually much faster to kind of go short and sharp and get the pain over with than not. So I think the US economy is actually looking pretty healthy now. Maybe a bit too soon to say that. I know everyone's very excited by the latest inflation data, but I think probably we need another quarter or two to really see that we're on a good path forward. Earnings season was surprisingly good. So this is talking about Q2 earnings, not the earnings that's just happened / still concluding at the moment. that earnings season was surprising. There were a lot of beats in there. There was a lot of lifted guidance even in a lot of the earnings calls, and that was obviously much better than the market was expecting, which led to a bit of a rally through the quarter. So again, quite a lot of volatility in the markets through the quarter. Ukraine had a massive counter-offensive. Obviously, we've just seen now that they've had another counter-offensive in the south, but at the time, this was a counter-offensive in the north, and they took back a lot of territory. It seems like the narrative really changed for the war or the conflict in Ukraine's favor, and obviously that meant that the European market saw a little bit more relief because it felt like there was some progress and that perhaps it was the ball was more in their court than in Russia's, so to say. Still a long way to go. There's an awful lot of commodities and things impacted by the conflict in Ukraine, and most of them are in that eastern end of Ukraine. So everything from uranium and iron ore and things like that, through to, even a lot of gases and things that are used in semiconductors and things are located in Ukraine. And obviously, the big talking point, I think, internationally was gas and food supplies, wheat especially. So all of those were affected by this, and still are affected by what's going on in Ukraine. As things are progressing, I think we're starting to see Ukraine looking a bit healthier in the western side of the country, and life is turning a little bit more towards normality in that half of the country, but still a long way to go in terms of getting the situation under control. And obviously winter is still coming, so we'll see how things go in terms of gas supplies and everything. Rate hikes, it gets a bit boring talking about rate hikes all the time, but yep, they're still going, still 0.75. So the rate hikes, again, every time they've happened, they've moved the markets because the market has their expectations of what they're expecting to happen, and so far they've actually been wrong more often than right. At first they were too light, and then they were too bearish, and it's been a bit of a roller coaster keeping up with it all, to be honest. But when you actually look at the inflation data, which I guess, moving on to the last slide, there's a lot of speculation that we have peaked already. I still, even after this latest report, which wasn't out at the time that I presented this in the last, when I presented this on eToro's call a couple of weeks ago, even still, I still think it's too early really to be saying that inflation is under control. There's a lot of things that can drive it, that are driving inflation on both supply and demand side. So it's I think we're going to need a bit longer really to get some clarity on this before we can really switch to full bullish mode on the portfolio. But in Q3, again, like all of these things combined to just make it a very, very volatile quarter. But overall, markets kind of stayed somewhat resilient, largely, I think, because of the inflation situation starting to look a bit more optimistic in the US. In terms of trades, I always like to highlight a few. The first one is my favorite. I didn't really include Tesla in it, but maybe I should have, because they've had a pretty bad time as well, and I was shorting them through the quarter as well. But the first one is short Meta, long Twitter, and when I presented this before, it was, I think, the day after Facebook's earnings came out, and obviously there were horrific earnings for Facebook in the quarter, so really, really not good for them. And I think, I'm just incredibly bearish on the entire pivot towards metaverse that Meta is doing. It's ludicrously expensive. We've just seen recently this week that they announced another 10,000 job cuts, which does not come as any surprise to me. They're an ad-driven business in terms of revenue, so it's obviously going to be a struggle for them during a kind of global recession, potentially, if that happens. Certainly a recession in a lot of areas in Europe. and the UK, which means less advertising spend. And if there's less advertising spend, then Facebook is not going to do as well. So I've been shorting Meta pretty much since the start of the year, on and off. I've closed all of the shorts now, so I don't have any open on Meta anymore, because I do think that it's starting to get a bit too cheap, just in case they, really do actually kind of give up on Metaverse and pivot back to their original business strategy. But if they continue down the path of the Metaverse, I think, we could see the price fall significantly further. On the flip side of that, I was long Twitter. And you may be wondering why on earth I was long Twitter, and the answer is that I was incredibly confident that Elon would be forced to acquire Twitter. And we basically saw that that's what happened. The court case started. Some of the things that were coming out were incredibly damning against Elon. I'm sure he was advised that he didn't really have any realistic chance of winning. So he gave up and bought it and took the kitchen sink in, and then continued to sink the company afterwards, and still continues to this day to sink it. Quite how he's managed to make such a disaster of it, I'm not too sure. As I mentioned, I was also short on Tesla at the time for the same reason. I felt like he would have to take money out of Tesla in order to help cover some of the costs. The costs for running Twitter, it was losing around $1 billion a year before he went in, so it's probably losing even more than that now. On top of that, he's got massive debts that he's piled up in order to make the acquisition, so he'll have to be paying those off. They're also going to be about $1 billion a year, so he's burning minimum $2 billion a year in Twitter at the moment. And I don't to be honest, it makes me tempted to open the shorts back up on Tesla, but for the time being I'm resisting. Next, that was a fun trade. I really enjoyed that trade, especially because it's long short. There's some sort of kind of decreased risk because of the correlation between the assets. Heat pump growth. So this is another trend that I identified in Q3. Well, I actually identified it about 2 years ago. There are some companies that I would love to be trading in this space over in Japan, for example, like Daikin and stuff. But luckily, eToro was able to give me access to NIBE, so I've added exposure to NIBE, which are a Swedish heat pump company. I already had TT and Train Technologies and Carrier International. I think they're called International. Carrier Group in the portfolio, who are both US-based. This is a pretty good mix. I really want a good exposure to the European market specifically, because I feel like the transition away from using gas heating is obviously front and center in Europe at the moment because of what's going on with Ukraine, and we saw that come through in earnings. NIBE absolutely smashed their earnings. TT had very good earnings. It's all looking really good for the heat pump market. Phenomenal growth there. I think there's probably a lot more to come. To be honest, I see it taking over the heating market generally. I don't really see very many alternatives apart from edge cases where anything makes more sense than a heat pump. Providing that the buildings are built pretty well. So, that's an area that pretty happy with the results that we saw come through from earnings at last, and really kind of justify that trend a bit more. There was also a big shake-up by Ford. So Ford was my largest position at the start of the year. Since then, it's kind of jostled around in, first, second, third place a few times with a few other companies. But Ford have had a rocky kind of start to the year, but they took a very bold decision to completely shake up the dealership model in the US. So in the US, you have car dealerships and they're allowed to add markup onto vehicles, and it's all very silly and very confusing. And it means you can pay very different prices for vehicles depending on where you buy it and which dealership you go through. So Ford is essentially trying to streamline all of that and somewhat take a leaf out of Tesla's book and kind of improve the experience for consumers. And it does mean a lot of pain, a lot of backlash from dealers in the short term. But we've seen already that GM and a few other companies are looking to follow Ford's lead on this as well, and also clean up that side of the industry. And I can only really see it as a good thing. the price of Ford actually did increase a bit when they announced that news. So I just wanted to highlight that. Really, it's not so much a trade. I'm still just kind of holding on to that exposure to Ford. Still very much believe in their products, the F-150 and such. But it's interesting news that really kind of moved the market, not just for Ford, but actually for the industry generally. It was really big industry news. Next, finally, I should say, in terms of the trading highlights, we have solar. So Enphase Energy were the ones that really kind of kicked off the earnings season, and I guess Jinko Solar did as well for the Q2 earnings, so last quarter. That took place in Q3. Well, it wasn't Q2 for everyone because companies are strange, but that's besides the point. It was it was a phenomenal earnings. They absolutely destroyed earnings and really highlighted that the only limitations they have are essentially around tariffs and regulation for the most part, and some supply chain issues. But when Enphase reported their earnings and the share price, jumped by some 20% or something, can't even remember what it was now. But when that happened, it lifted the entire industry immediately. And then as earnings came through from everyone else in that sector, we saw that, it wasn't just them. It was pretty much everyone in the sector. The only one that was actually a little bit disappointing was SolarEdge, who, when you compare them with Enphase, who were their main competitor, really didn't perform quite so well. So I did reduce my exposure to SolarEdge a bit on the back of that, because this is becoming a bit of a trend there, whereas Enphase seemed to just continually be delivering earnings after earnings, which is pretty amazing work, to be honest. But yeah, this really helped up a portfolio. I think it's actually the main contributor to what helped us outperform during the quarter is our exposure to solar. So talking through Q4 and what we're really looking at in Q4, it's the same old topics really to some extent. I think the first thing obviously is interest rates. We know that there are more hikes coming. I can't even remember what I wrote down in this little paragraph now, but I think along with what we're seeing with interest rates, we're likely to start seeing a lot more fiscal policy coming in to support the monetary policy. In some countries, that will be, essentially using the money printer and going out and spending and trying to stimulate the economy and make sure that the economy stays resilient. In some countries, we'll see it come through as austerity instead, where they're cutting back at costs and trying to save some money, so as to make sure that the currency remains attractive for investors. Obviously, that will have widespread repercussions. All of this still dependent very much on interest rates and what central banks do. I think the UK and Europe still have a lot of way to move on interest rates before they really get to a point where it's actually going to start making a good impact. But to some extent, I think their hands are going to be tied soon by the amount of pain that is being felt by the economies that they're trying to stabilize. So it's it's a difficult situation in Europe, especially. I think it's going to be a pretty tough year or so for a lot of people, and a lot of companies as a result. Certainly, companies that are kind of not really producing good cash flows. I think they're going to be struggling a little bit to really kind of keep their heads above water and produce a return for their investors and justify their valuation. So it's going to be an interesting time in Europe, especially for those more risky equities. Next up is the energy crunch. So, I've talked about this for the past, since the war started. Actually, I talked about it before the war started, that there was already an energy problem across a lot of Europe before the war in Ukraine even begun. And we're now approaching the winter. Obviously, all of the gas stockpiles are full across most of Europe. They've topped them all up to try and weather the storm through the winter. And really, I think most of Europe, especially Germany, the UK, Italy, are really hoping for a nice mild winter, so that the amount of gas they're consuming is not too high. Um, I was holding a short position on Germany that I actually closed today, this morning. And I think the reason for that is that the advancements in the Ukraine conflict and the kind of increasing, I guess, speculation that Russia is potentially wanting now to negotiate rather than wanting to pretend to negotiate on peace, and the implications that that may have for gas supplies, at least in the short term, or even for Ukraine to take advantage of the gas in their own country, or some of the pipelines in and around the area from other countries in the region. All of that is kind of impacted by that, and so the energy crunch isn't looking quite as bad now as it was when I wrote this, but I still think it's one of the biggest risks and something that I'll be watching very, very closely through Q4. We still have a lot of exposure to nuclear, to new wind construction, and solar, and I think that those trends are going to remain on track regardless of what happens. So pretty happy to keep exposure to them. And finally, we have spending habits. So I think this is going to be a really interesting one. Even I think mapping what was happening at the end of COVID and how different companies, like the kind of favored COVID stocks, were going to perform once lockdown kind of ended, and then also how spending habits were going to change as a result of all of the inflationary pressures. These were really kind of interesting things to be looking at, and I think that especially for the retail industry, we're going to see make or break for a lot of companies. Actually around now, really, because Black Friday is obviously incredibly important. Cyber Monday, they're coming up, and those are the big earners for most retail companies. Obviously, people are spending less and changing their spending habits. We just need to wait and see who comes out of this in a favorable position, and analyze, how much of that was to do with marketing and the geographies that they're serving, and how much of it was to do with changing consumer habits, because there could be really big implications for a lot of different companies out there, depending on how that goes. So that's the final thing, I guess, that I'm really looking at in Q4. Obviously, I could have added a lot more things to this list. Still watching the COVID situation, still watching what's going on in relations between the US and China and Taiwan, and even the protests that are going on in the Middle East at the moment. There's a lot of things going on in the world, all of which are impacting markets. Not to mention what's just happened with crypto, which has not even featured in this update. Crazily, a few years ago, I couldn't imagine writing an update without any crypto updates, but Q3 managed to have no crypto involvement whatsoever because there's just so much going on elsewhere. And the portfolio is still very light on crypto, by the way, so incredibly light on crypto. I digress. That is the end of my slides. I will now take some questions from you guys. Before I do that, please beware of scammers. On social media, especially Twitter, Facebook, Instagram. There are a lot of people impersonating me. I'm surprised that nobody paid $8 to get a little blue check mark next to their Twitter name so that they can pretend to be me slightly more effectively. I guess maybe it would have given the game away since I'm not verified on Twitter. But yeah, these are my official social medias. Feel free to join them. If you want to join my Discord, then you can check that out as well. Great community of people on there talking away. Honestly, I contribute less than they do, I think, these days. But it's a really nice little community on there. So anyone's welcome to join that, even if you don't copy me or if you're another popular investor or whatever. But yeah, I'll be happy to try my best to answer some of your questions now. I'll start by scrolling up because I know that there were a few at the start. Whether or not those people are still here, I don't know, but I will try and address them. If you can make it more about this quarter, then that would be preferred. Okay. Apparently many countries are now working on central bank digital currency. What if they include introduce a ban to crypto. Yeah, there's been a bit of talk about this recently. I mean, I've said for a long time that is always a risk, that they do that. In some ways, I think it's unlikely that they would just kind of straight up come out with a ban off the spot, because it would impact too many people in their country, and there would be too much political backlash from it, I think, especially in terms of the wider impact that would then have on the crypto industry as a whole. So I suspect if they do go down the route of central bank issued digital currencies, that they will be more in kind of competition with what's already provided, at least to begin with. Maybe it would be a more kind of phased in ban on the competitors like Tether and USDC and things like that. I also think that realistically we're still a reasonable way away from this actually materializing. There's a lot of talk about it, but governments are notoriously slow at most things, let alone technology things. So I wouldn't be too worried about it being, anything imminent. Let's see what else we've got. Not too many questions today, I must say. It's all very quiet in here. Someone asked how my Peloton position's doing. Well, I got rid of it a long time ago because it was doing badly. It was doing very badly. I got out long before it reached its lows, luckily. Sadly, not all at once, because that would have saved me a bit more money if I just did it all in late 2021, but I didn't. I held on to some of it into Q1, and then that's where I really got rid of it. So yeah, pretty happy not to be holding it. That said, I still think that company has got very good prospects for acquisition, and also for potentially even recovery now that they're under new management. Yeah, it's not something that I'm probably going to add to the portfolio, and certainly if it was, it would be a very small position. Are you bullish on Bitcoin going into the halving in 2023? No, not really. I can't say I'm that bullish on anything crypto at the moment, unsurprisingly, given what's going on, perhaps. Yeah, I think, a few people have asked, when do I think the right time is to get back into crypto? And I did, until this happened, I was starting to think maybe soon, maybe next quarter or something like that. But even before the whole FTX situation happened, it went from being not uncorrelated to markets to being correlated with markets, which was fine. It rallied when they rallied. But then it was bad because it declined as they declined, as interest rates changed. And now it's gone back to being uncorrelated again somewhat, and is falling while markets are rising. So even though people are kind of adding risk again, I think there's a bit longer to go yet, to be honest. Yeah, I guess it depends. It depends on your exposure, really. Like in the portfolio at the moment, I have some indirect exposure that I added recently because I added Block back to the portfolio, Square. And there's, some small bits of exposure elsewhere as well. And I do have, I think I've still got it, one very, very small Ethereum position on the top as well. But I think we've still yet to see the space kind of get cleaned out a bit. I think NFTs. I think the floor price on Bored Apes has come down from 600,000 or whatever it was down to maybe 50,000 now. But to be honest, until that comes down to 5,000, I don't think, or maybe 10,000. I don't think we're really at the bottom. There's still a lot of people actively scamming in the space, and I think actually that's a pretty good kind of sentiment signal to look for, right? Is when the scammers give up because everyone else has given up, right? I think that's that's maybe the thing to look out for in terms of where the space is at. There's still things like Hex is what I would consider to be fraudulent scam coin. It's still operating, but that's my opinion. not a fact. It's not an accusation. I think they might be. They might not be. They probably are, though, in my opinion. While things like that are still operating, I mean, how can you be bullish, right? I think you need to really see a big clearing out of some of these kind of cowboy situations. I mean, even some of the stuff that's been going on with crypto.com sending 320,000 thousand ETH, or was it $320 million worth of crypto to Gate.io by accident. It was meant to be going into a cold storage wallet, and they accidentally sent it to a different exchange. How do you accidentally send 300 million to the wrong address? It's just ludicrous. You couldn't dream of something that bad in the financial industry going unnoticed. So, yeah, things aren't looking great there, to be honest. I think for a bit longer, it could. Things do tend to move a bit faster in crypto because of the transparency of the blockchain. Means that once you have something like FTX unraveling, it's very, very quick and easy to kind of follow the blockchain and find other things that could be affected. So where the financial crisis was kind of dragged out over the course of a year and a half, in terms of all the companies unraveling after Lehman Brothers, in this situation, I think it's going to be a bit faster than that, but it's still going to take months. Until we really see that, and until we see how regulators react to this as well. I mean, there's a hearing going on in the UK today about cryptocurrency with a government hearing. So until we really kind of see how governments respond and understand the real fallout of the situation, I don't think it's a good time to be adding money into crypto at the moment. I think it's much better to just kind of wait it out a bit, and maybe you pay a little bit more in 3 months or 6 months or even 12 months to buy back in, but you're doing so with a much, much lower risk situation. Questions coming thick and fast now that I've started talking about crypto. Again, I'm not going to answer too many questions, and ideally I'd rather keep it focused on Q3, but because I have got a Q&A live stream coming up as well, so you can tune in for that if you want a bit more. Let's see what other questions have we got here? Opinion on cryptocurrency. You were very bullish. You're predicting 100k for Bitcoin. Was that in 2020? Or is that in 2021? Maybe it might have been in the start of 2021 I made that prediction, yeah. How wrong could you possibly be? Lol. Oh dear. Yeah, I mean, pretty wrong it seems. Pretty wrong. But hey, I also changed my mind, which is the bit that most people don't seem to talk about. The fact that in early December, and actually in November last year, I said that we were at a top. And by the start of January, I had removed almost all of my exposure to cryptocurrency. So while everyone else was sitting on their losses watching it tank, my portfolio had got rid of it. So yeah, people love to call out the ones where I'm wrong, but there are also some where I'm right. And sometimes it's not about the money you make, but the money you avoid losing. Do you think we have hit the bottom, and moving on Q4, should we see some recovery if inflation is tamed? I think that's the key thing. It's if inflation is tamed, and I think the last part of my presentation as well that I mentioned, if I can go back to it, the spending habits and the energy crunch. I think those are going to be two of the big deciding factors on how bad things are or are not, and how quickly we are able to recover. I think politically things are looking pretty good in the world right now, actually. I'm quite optimistic about the way things are going. The Brazilian elections, the fact that the US and China seem to be talking again, Russia seems to be going a bit more quiet, and, everyone's called their bluff about 30 times now. The conflict in Ukraine, those things are going pretty well now, I would say. In terms of general geopolitics, things are looking slightly better on a global perspective, apart from maybe India and a few other kind of situations like that. Certainly, in Eastern Europe on the kind of borders of Turkey, there's still a lot of things going on, and some stuff in Central Africa as well. But overall, I think things looking good on that kind of macro perspective. But really, it comes down to the energy crunch. If Europe basically runs out of gas this winter, there's going to be an awful lot of pain, because you're going to see, the first thing that is in most countries kind of contingency planning is to essentially limit the activity of business, because business tends to use a lot more energy than households. So if that happens, you're going to see disastrous quarters for earnings and things, and potentially you're going to have to see government bailouts for companies that then hit financial difficulties as a result of being unable to operate. That will have knock-on effects to the people that are supplied by those companies. I mean, that alone could be a really big, very damaging situation. On top of that, we've got the spending habit stuff. If people stop spending, then that's going to hit another different segment of the economy, right? All of the retail section of the economy, potentially luxury goods, things like that. If you combine, those two things together, if both of those things are bad, then we're in for a pretty rough ride, I would say. If not, I think, we could be at a bottom, certainly in the US, possibly a little bit longer for Europe, though, I think. And the UK, to be honest, I think we could still be a year away from the bottom, maybe even longer. Personally, I don't really see a situation where the UK can recover its economy very easily without quite radical changes and or rejoining the EU in some form. And even then, the damage has already been done to some extent. So I think, very, very pessimistic on the UK, sadly. That's my opinion. So even if inflation's under control, those situations could still mean that we're facing a lot of hardship. Have you talked about star? I know you're impressed with their model in bull markets. No, it's been a rocky few weeks. Crypto.com. Yeah. I guess put out crypto.com. Yeah. I see you wrote that below now as well. I wouldn't be keeping too much money in there, to be honest. As much as he did give a very good talk in his Q&A, as have many other companies, and there's a lot of companies saying the right things. Celsius also said the right things. FTX also said the right things. In my opinion, even Binance says a lot of right things, but when you actually dig down into the kind of the sub layers of how things are structured, even Binance I find incredibly suspicious, and not to mention the actions of CZ's kind of involvement in this. Not that I'm accusing him of anything specific, and I don't think he did do anything on purpose, but when you actually look at how regulators interact with these companies and where those companies are based and how many different companies there are, and the holding groups and who owns what, it's a complete mess. And the only reason you would make it that messy, to those extremes, I think, is if there is potential that you may wish to pull a bit of a rug pull, so to speak, or that at the very least you see it as a very likely scenario and you want to protect yourself from it. So, I would say be careful. That being said, I still have money on some of those places. I lost some money in BlockFi. Well, I don't know if it's lost for sure yet, but certainly I'm treating it like it's lost. I got caught up in the aftermath of FTX as well. But I think realistically, those kind of yields have always been somewhat unsustainable. but at the same time, they're not like outside the realms of viability. So really, it comes down to how much you trust the management team and how much you want to risk keeping on those kind of platforms. Hi Jay, would it be wise to put some more cash into copying you at this point in the market, or do you think it's prudent to wait? I already have a fair amount invested, and if so, should I copy open trades? Okay, first of all, always copy open trades. If you don't copy open trades, then it takes far too long for your funds to be invested because some positions, don't get cycled for a year. In fact, there are some positions that I can't cycle because I can't get liquidity through eToro to trade those positions again. So yeah, always copy open trades regardless, is what I would say. And as a result of that, always make sure that you are copying or adding funds that are equal to or more than the minimum recommended amount by whoever you are copying. Otherwise, you will not have enough funds going in to open those positions because the minimum trade size on eToro and such. So those are the first things. In terms of if now's a good time, to be honest, I think it is a good time. Overall, I wouldn't, throw the whole lot in. I would certainly be a bit more cautious than you would normally. Whatever you're thinking of investing, maybe take 10% off just because of the fact that the global economy is in a pretty uncertain situation at the moment, and you don't know how much of that you might need necessarily. Even if you've budgeted for it and you're the most sensible person in the world, it doesn't hurt to have a little extra safety barrier, because you don't want to be forced into a position where you have to pull it out of the market when it's potentially drawn down. So, I would add that caveat. But again, I don't know your personal situation or anyone else's. So obviously, consult your own financial advisors or think about it for your own situation if you're saving for a house or whatever it is that you're, trying to do financially. But overall, I would say that now is a good time, to add funds. Maybe not all of it. If you want to kind of space it out and do it over the next quarter or 2 quarters, or even over the next 12 months, wouldn't be the worst thing. But I would certainly say that it's probably worth adding some now if you have the capital available and you're happy with the risks involved. Someone said, good chance of a 2-year global recession and property crash, ? I'm not sure if it was a question or if it was a statement, but you added a question mark, so I'm going to assume it is. No, not a good chance of it for 2 years. I wouldn't say so. In the UK, I would say so, definitely. In Europe, I would say quite probable. In the US, I would say less probable. For 2 years, is a pretty long time. And the other thing I'd point out is that markets tend to bottom a lot earlier than the economy does. They price in that these things are going to happen, and then they start to bounce earlier. So even if we do delve into a recession, don't be too surprised if markets start actually performing reasonably well during that period. Which is why, as I said just now, I think now is actually a pretty good time to be adding exposure to markets. When BitBoy quits YouTube, it will be time to buy crypto. Yeah, him and numerous others. Yeah. Okay, I don't think there's any more questions. Oh, there's one more. Someone's just asked. Hey, Odie, how's it going? Another question about dollar supremacy. When do you think dollar will come to earth? As it's really impacting us when we want to deposit money on eToro from a different currency due to the exchange rate? That is actually a pretty good question, to be fair, and not something that I'd really considered, because obviously I don't really add funds to my eToro account because of the fact that it would impact all my copiers if I were to do so. and ask them to do the same. So it's not something that I've actually genuinely had to think about that much. Yeah, it's a difficult one. As I said, I think Europe and the UK, and China certainly, I think as well, Japan probably. I think most economies are looking worse than the US economy currently. With the exception of some of the kind of like hyper-growth nations, the Philippines, Indonesia, Brazil, a lot of those kind of nations I think are potentially a good option now, and may outperform and do well. Whether or not their currency does, though, is still another question. I don't really see a scenario where they make up that much ground, to be honest. I think the gains that you would get from being invested would probably outweigh any kind of negative effects from exchange rate. And I think the other thing you've got to remember is, at what point are you taking the money back out of the market and putting it back into your local currency, right? Because you can account for what the exchange rate is now and think, "Ooh, do I want to put my money into dollars so that I can invest in, the markets through eToro right now, or do I want to not do that because exchange rates are bad?" But if you're not considering the other end of it and when you're taking the money out, then I think you're only looking at half of the equation, really, because if you're not planning to take that money out for 10, 20, 30 years, you have no real chance of knowing what exchange rates will be by then. And sitting out of the market for that entire amount of time would obviously be ludicrous. Equally, I don't think it's that easy really to predict where those currencies are going to go in the next 12 months, to be honest, because we just don't know how bad this winter's going to be. And we don't know how quickly inflation will be tamed in different economies, and the central bank and political response to that. So I would say that it's probably just better to ignore it, to be completely frank. I think it's better to just ignore the exchange rates at the moment and just think, do you want exposure to stocks when stocks are at very low, to equities when they're at very, very low prices compared to where they were over the past few years? Or do you want to be sitting in cash and maybe have it in a bond or treasury or something like that and be earning less than inflation in most cases? For me, I think I prefer to put it in equities. So I would say don't consider it too much. That's an interesting question someone's just asked as well. Let me read the other one first. Have you caught any market leaders for the next run? Crocs, maybe. You know what? I do quite like Crocs. I kind of feel bad though, because the person that I remember getting into Crocs first was Robert Merck, and I don't like the feeling that I've like stolen an idea off someone else. I like to come up with my own ideas myself, even if other people have good ideas. Sometimes I'm more hesitant than maybe I should be to just adopt an idea that is good. Crocs is one that I have considered quite a few times, to be fair. It's just one of those products that seems to have good appeal. But I don't know. I haven't looked into it specifically in a few months now, so I'm not sure on it. As I said before, I still think anything to do with electrification is still a really, really good cash cow for the next 2 or 3 years, especially in Europe. I think heating systems are going to transition dramatically. I think smart home stuff is still a good investment. There's a few companies I was looking at in that space recently, like Vivint Homes, I think they're called, or Vivint Smart Homes. I can't remember what their actual full name is. There's companies in that space that I like. I think semiconductors will be attractive again sometime in the next 6 to 12 months, and they should do very well. But I don't think it's quite time to go big into them just yet. I think, there's quite a few things. But I'll answer it with an answer to the next question, because someone asked, if I can find it again, it's just moved. There it is. Details on your investment into Boys Cascade and the rationale behind it. Yeah, so BCC added to the portfolio quite recently. I think there's a few things behind it. First of all, the massive cooling off in the timber markets after the kind of insane pricing stuff that we saw through 2020 and 2021 as a result of COVID and supply chain problems. So that's the first thing. Market collapsed dramatically from its peak and is back down to much more sensible levels. Second thing is that BCC specifically, well, I mean, they're kind of a complex company because they do a few different things, but one of the things I really liked about them is the amount of exposure they have to various different types of engineered wood products. So you can have there's a few different things, right? So there's the growing trend of timber-based building, not just for homes, which has always been popular. Timber frame homes have always been popular in many parts of Europe and the US, but also for kind of more industrial buildings. And for those buildings, they have to use engineered wood, where they essentially they take the wood and they kind of glue it together in different grain orientations, which dramatically increases the kind of load-bearing capacities for it. And so you're getting more and more skyscrapers and kind of warehouses and things, and football stadiums even, that are built using predominantly wood now instead of things like steel. So that can work out obviously as a much more sustainable option because of the fact that it doesn't involve steel and it doesn't necessarily need as much concrete because it's often lighter and all the rest. And also, you know, they make more warm and inviting buildings in a lot of cases as well. There's also then like the other kind of products that are kind of based off that. A lot of kind of like sort of fiberboard-esque materials and kind of glue laminated wood product materials as well that are also growing in popularity. Again, because of the way that the kind of technology has evolved around it, and the fact that, you know, by laminating these materials together, they are just much more useful products to build things with. So yeah, that was like the main kind of thing behind it. But I also just generally liked the way that their business was set up. They work with a lot of different kind of retail outlets for their products. They have their own kind of retail operations essentially. So they're a bit more diversified than some of the other companies that were in that space. And yeah, the valuation just looked good to me. You know, they've had a good story, good growth trajectory through the year. I was watching them a bit earlier in the year and spent quite a lot of time reading through various research papers about the growth of the timber industry and everything else. And yeah, no, I like the way that they're operating. Only potential downside is some of the way that some of their staff are treated doesn't look amazing. It's nothing like crazy bad or anything from what I can see. But potentially there are some issues there in the US, but it's, you know, I don't think it's that big of an issue. It's in a similar kind of tier to a lot of the US rail stocks that I'm investing in, like CSX and stuff, where, you know, some of the cost-cutting kind of things that they've been doing with staff are justified in terms of a business perspective, but still aren't great in terms of how they're handling it. So, you know, that's maybe a slight concern on that side in terms of like sentiment and you know, making sure that their staff are happy and everything. But apart from that, yeah, I like the stock. To end on a bit of a meme, I like the stock. Yeah, so bit of a rambling answer. Yeah, no, I like the look of their balance sheet and everything. I think that will do it. I've been going for a pretty long time now. Normally these ones are a bit shorter than the Q&A one. I didn't give a reminder on eToro before it. So yeah, if you're just joining and you missed some of it and you want to watch it back, then feel free to jump onto YouTube and check it out when I upload it tomorrow, or it usually appears in the video section on Twitch pretty quickly after I finish streaming as well. So you can skim back through it there as well. That's it for me. As mentioned before, check out my website and my social medias and stuff if you're not following me, or of course on eToro. And yeah, thanks for watching, and I will see all of you guys next time. Bye.